Back on Market Eye, let's talk about the market that was today, and nothing short really of a sea of red. Ritu Arora, Chief Investment Officer of Canara HSBC OBC Life Insurance, is joining in on the show. Ritu, good evening. Thanks so much for taking time out for us. China sneezes and it's like Indian markets catch a cold. What do you make of the Indian market collapse that we saw today on the China sell-off? Because so far we were managing to hold out pretty smartly despite all the volatility in global markets.
Clearly, currently markets are dominated by global sentiments, be it Brexit, be it the meltdown that we are seeing in China, or even the fact that commodities are correcting very sharply. And nothing is really decoupled. Indian markets now move in tandem with global markets. FIIs could get into a risk aversion mode, and I think that is the worry on everyone's mind, seeing sharp movements like this across the globe. And I'm not surprised that we're seeing a correction in our market, coupled with what's happening around us.
Sure, Ritu, but how much more weakness can be expected in India because of all of that, what's going on globally? Purely on the valuations front, what's your assessment?
Indian markets, like I said, are not decoupled. So for the next couple of weeks, I think global economics and global news flow will dominate the market. If we were to isolate that and look at only the Indian markets, we are currently trading at 18 times FY16 and about 16 times FY17. Hence, the market is not very expensive. The domestic fundamentals have only been progressively improving. Inflation has been in line. IIP numbers have been showing improvement. There are green shoots to be seen on stalled projects are moving. The currency has been sturdy. The reserve position has been improving. RBI has already given us 75 basis points cut, and we may have another 25 basis points on the anvil. And hence, Indian economy, with monsoon also playing along reasonably well, looks relatively poised for a recovery and growth to come back and earnings to look better in next few quarters. But it is not possible to isolate.
So what exactly your advice be for investors who are watching our show right now? Should they be buyers in spite of these sharp gashes and declines we are seeing in the market?
I don't see a very sharp correction in the market, but a 5-7% correction is warranted if we continue to see this kind of a global meltdown. And hence, there are very many opportunities that investors have for investing. If the time horizon is 3 years, definitely every dip is an opportunity to buy. But rather than a top-down sectoral play, I would recommend that investors do bottom-up stock selection, where you buy into only steady revenue stream, good profitability, earnings growth companies.
Okay, so if some of these low levels are good opportunities to buy, then Ritu, what is it that you folks, particularly are bullish on and you would advise that one should go ahead and buy?
I believe volatility will be the order of the day for the next couple of months because earnings are not going to be revived in a hurry. I do not have great expectations of this earning season as well, which means that there will be very sharp stock-specific movements depending on how each company's results are, and the overhang will remain the global macros and global news flow. Hence, I prefer a balanced portfolio of good quality. I have companies which have high earning visibility. If I were to look at sectorally, I definitely prefer private sector banks still. IT gives me a good valuation entry opportunity. Pharma and FMCG with their earnings visibility gives me stability in the portfolio. I like auto anks. But selective stocks within these sectors. So it's more of a stock call within these sectors than just a blanket sector call.
Okay, but what about the big picture, Ritu? A last word really on how convinced you are about the macros, which many believe are actually on the mend.
I believe so. I believe there are a lot of structural things. Macroeconomics has never looked better for last many quarters, and things are falling in place. Of course, the biggest thing that we will look out for on the domestic side is a return of corporate earnings, which we haven't seen. Last quarter was very dismal, very worrying, where we saw almost 10% degrowth in revenues and 13% in revenues and 10% in profitability. And this quarter doesn't have great promises. So return of an improvement in corporate numbers is something that will be the key important thing to look forward for.
All right, Ritu, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
All right, with that, let's get you some more fundamental opinion going on the market.